Welcome. It's Tax Tip Tuesday with me, Christine Walters, on today, Tuesday, March 14th. What investments qualify for some tax deductions on your personal tax return? So, I often get asked if you can deduct the interest that you paid on money that you borrowed to use for investment purposes. So, the short general answer is that yes, you can deduct any interest that you paid on money that you borrowed to purchase investments, but only in non-registered accounts. So if you borrow money or do an RSP loan or something like that, because an RSP and a TFSA are registered accounts, any interest that you pay on money borrowed for those types of loans are not deductible. It's only money that you put into a non-registered investment account. And then with that, you need to be aware that there are also some limitations on the money that you can deduct for non-registered accounts. So the CRA guidelines state that most of the interest that you pay to earn income on your investments can be deducted. But if your investments are only earning you capital gains, are only producing capital gains for you, you cannot claim the interest you paid on the money used to finance those investments. So if you purchased a piece of land and you've got a mortgage on it and that land isn't generating rental income or farming income, but will only provide you with a long-term capital gain, your interest may not be deductible. And I caution that may, as you guys probably know from listening to multiple of my Tax Tips Tuesdays, taxes isn't black and white. It's all about the context and the situation. So again, advise you to reach out to your tax professional to see whether or not the interest in your situation is deductible. Another example would be if you are buying stocks that don't pay dividends. So if you're, again, stocks that don't pay dividends, ultimately you're in it for growth. So you're in it for the long-term capital gain. So if that's the only thing that's in your investment portfolio is stocks that don't pay dividends but grow quite nicely over time, you probably can't claim the interest that you've paid on your investment income, on that investment income. So the other thing I'll throw in here is that for those of you that have a non-registered account, you should be getting at the end of the year, December, January package from your investment brokerage, whoever it happens to be. And in there, there's usually a page that shows the management fees that you've paid on your investments. So most investments charge anywhere from 1% to 3%-ish. And you don't even realize you're paying it because it's just coming out of your portfolio, so to speak, and paying the investment broker and the brokerage. So those fees that you are paying to the investment brokerage that you might not even realize you're paying can be deducted, again, most times on your tax return, on your personal tax return, against the investment income that you're earning. So to avoid confusion, for those of you who do have some borrowed money, you have a HELOC or a separate line of credit that you've used to finance some investments. To avoid any confusion or problems with CRA down the road, it's advisable that you keep your household debt and your tax deductible debt separate. You shouldn't migrate the two, so you shouldn't take your $50,000 HELOC and put $25,000 into investments and use $25,000 to pay off a personal credit card. And the reason for that is that when it comes to CRA and a review or an audit, CRA may allocate your repayments to that HELOC first to your tax deductible debt rather than your personal debt. And by allocating it to your tax deductible debt, that reduces or eliminates the interest that you get to claim as a deduction on your tax return. So there are lenders, banks, financial institutions out there that will allow you to separate your mortgages or your lines of credits into multiple accounts in order to simplify tracking. So if you had a $300,000 mortgage and you wanted to put $50,000 into investments, non-registered investments, you could ask your bank to set up like a sub account or an A/B account kind of thing, so that when you make repayments on one, it doesn't affect the interest that you might get to claim on the other one. So I hope you enjoyed this week's Tax Tips Tuesday with me, Christine Walters. Please come back again next week for another tip and enjoy the rest of your week.